Hello, everyone. Normally, I am slated for the ethics portion, and we're like, well, how can we make a topic even more boring? I'll do taxes. So this is fun. I told them that, I'm not doing ethics anymore. You can only make ethics interesting like 3 years in a row. So then I threw the short straw, and now I have taxes. So without further ado, we are going to talk about tax issues in divorce cases today. Disclaimer. I am not a tax lawyer, nor am I an accountant. I've actually never taken a class on accounting. A wise person once said that lawyers are lawyers because they are terrible at math and science. If they were good at math and science, they would be doctors. And knowing that, I employ experts as much as possible. I have never seen a Missouri tax return, so we're going to focus on the review of the federal tax returns today. And today, we're going to talk about the tax issues that anyone who practices in domestic relations has to have an understanding of in order to provide competent representation and to make sure they're protecting their clients' interests in the negotiation process and the advocacy process before the tribunal. So today, a little breakdown here. We're going to start by talking about information to collect as a domestic relations practitioner, the explanation of the filing status options, some liability issues that we need to talk about, dependency exemptions, child support and alimony issues, and then we'll round it out with property division tax issues. So the first thing you need to do is get a hold of your client's tax return and the opposing side's tax returns. Best case scenario, right? Your client filed a joint return, they prepared it, and he or she has a copy of the return. And if he or she did not prepare the return themselves, they can contact the tax preparer, and the tax preparer can provide you with everything that you need. If the client doesn't have a copy of his or her return, they can obtain a copy from the IRS directly, but that takes time. Now, let's say they did not file a joint tax return. Don't issue a subpoena to the IRS thinking you're going to get a copy of the return or a tax information from the other spouse. The IRS actually will refuse to comply, and if pushed, they will have it quashed in federal court. The IRS will provide you with information concerning a taxpayer, but they have to sign a proper consent form. So if the opposing party won't give you the consent form voluntarily, then you can have your state court compel the spouse to sign the consent form. And then once you have the consent form, keep in mind that it can still take a couple of months for you to actually see that return. In addition to the actual tax form, you need to make sure you're collecting the supporting data, including the W-2. The return is not enough. You also want to make sure you're collecting and reviewing the supporting documentation that was relied upon when preparing the return. So let's start with that W-2. If you're really lucky, you're working with a W-2 employee, a person who does not own their own business, they work for Best Buy, and they have no additional income source. And if that's the case, the W-2 specifically, box 5, represents the total earnings of that party for the prior year. In addition to the W-2, I always suggest securing the person's last pay stub for the prior year so that you have a breakdown of how they received their income. This is especially important in situations where the employee has commissions or bonus earnings, because you'll be able to see on that last pay stub information that you're not going to be able to gather just from the W-2. And when there's a disparity between box 1 and box 5, which we'll discuss in just a moment, you're going to be able to see why there was that disparity by looking at that pay stub. Box 1 is the taxable income. So that's after contributions that have been made to a retirement account, as an example, and it reduced the total taxable earnings. Although you always want to get a copy of all returns and schedules filed by your client and the opposing party, if someone is not that super easy W-2 employee, then you're also going to really have to take a careful look at the tax returns and the schedules. What's a schedule, you may ask? Oh, I'm so glad you asked. A tax schedule is a form that the IRS requires you to prepare in addition to your return. So those are those documentation that after the return, those are the documents, those are called schedules. And when you have certain types of income or deductions, these include things like significant amounts of interest income, those 1099s that you receive are reported on there, mortgage interest, or charitable contributions. These schedules detail what deductions the taxpayer is taking, and that Schedule C is where you'll look at the taxpayer as a sole proprietor business. But if the taxpayer has an interest in a business that's not solely reflected on their Schedule C, say they have a partnership, for example, then you want to make sure you're getting your hands on their business tax return. So let's take a closer look at that 1040. Using that 1040 federal return tax form, provided the taxpayer properly reported all of his or her income, you should see a nice breakdown, lines 7 through 21. But keep in mind the wage boxes, if you had that W-2 employee, is based off of that box 1. So you don't want to just look at the 1040 and say, well, this is the person's total income that they received, because remember, you have to look at that W-2 and you have to look at those schedules. In addition, if you have that business owner, you don't want to just take 12 as the line 12 as the actual income available for support for that business owner. You should carefully scrutinize that Schedule C. For those business owners, you should demand to see their profit and loss statements as well as their balance sheets. In addition, for sole proprietor businesses, I'll also demand to see their personal and business checking accounts to make sure the business owner is accurately recording business income and expenses, because remember, these tax returns reflect what the person is reporting. And there have been a few people in history who have falsified their returns, so your process doesn't want to stop there. In fact, anytime an accountant is preparing the tax return, most of the time it includes this handy-dandy letter that says, I just went off of what this person told me. So if you're looking at income available for support and the person is a business owner, you're looking at the gross receipts minus the ordinary and necessary expenses incurred to produce those receipts. So depreciation, investment tax credits, or the non-cash reductions, which are all going to be outlined in that Schedule C, may be added back in when setting income available for support. A brief law update. This is complicated stuff, and it's difficult to know exactly how it's going to impact our clients who have businesses or their spouses who have businesses, but in general, the theory is that many businesses may find themselves with a lower tax liability. The corporate tax rate changed from 35% at the top tax rate for C corporations to 21% flat rate in 2018. There's also now a 20% deduction for qualified business income that can reduce tax liabilities for sole proprietorships, partnerships, S-corps, and rental real estate. And there's a new category created for claiming depreciation, 100% depreciation on short-lived new or used machinery and equipment purchased from September 28, 2017 to January 1st, 2023. The business interest expense deduction is capped at 30% of income for 4 years, and there's no longer a deduction for sporting event tickets, club memberships, and entertainment-related meals. But there's a reduction to a 50% deduction it used to be 100%, for meals, entertainment in certain categories like client business meals if business was conducted, meals provided for convenience, water, coffee, snacks at the office, meals during meetings, meals during business travel, and meals at seminars, conferences, and meals included in charitable sports packages. Again, pretty complicated stuff. Why does it matter? It impacts a person's ability to pay support potentially. So perhaps you're an expert, but I know when I need assistance here, it's time to phone a friend and get an expert involved. So keep in mind, if you're scratching your head, the judge or the trier of fact may have difficulty as well. So get an expert on board at the onset of the case who's going to provide you with litigation support. You can ask them the questions and then use that person to explain the situation to the court, especially when you have complex tax returns, business interests, capital gain, loss, and carryovers. So now that you have identified the person's income available for support and potentially identified the book value of a business interest, If you received all of your supporting documentation, either through your own review of the financial records or the assistance of your trustee accountant or business valuation expert, another topic that we need to explore before leaving that 1040 is discuss the filing statuses, as this is going to be important when you're negotiating filing taxes during the pendency of divorce action, and you negotiate who's going to claim the children on their tax returns each year in which the parties file a separate return. So there are 5 filing statuses. And note the filing statuses are mostly unaltered by the tax reform. We have single, head of household, married filing separate, married filing jointly, and then the qualified widower with dependent child. So the big question is, are you single? When am I single again? It's determined as of December 31st. So if you have a taxpayer who is divorced on December 30th, they cannot file married joint. You'll have people who will want to talk about it and say, okay, well, we'll just file married joint this year. No, if you are divorced in that tax year, you cannot file married. You have to file one of the separate filings, either head of household or single. It doesn't matter if you were divorced on January 1st of that year or December 30th, you have to file a separate tax filing. The marginal tax rate is important here as we're going through all the different filing statuses, because the marginal tax rate is the taxes paid on the next dollar. So easy way to explain, it's the percentage of tax applied to your income for each tax bracket in which you qualify. In essence, the marginal tax rate is the percentage taken from your next dollar of taxable income above that predetermined income threshold. So federal income taxes in the United States is a progressive tax. There are income tax brackets to assure this with increasing marginal tax rates for each bracket. So it increases as you go, with the lowest being married filing joint, then head of household, then single, and then married filing separate, having the highest marginal tax rates. So first, for head of household, you have to be married or unmarried or considered unmarried on the last day of the tax year. You need to have a qualifying person living with you in the home for more than half of the year. And this can be a child, a stepchild, a sibling, dependent parent, or other relative for whom you've provided financial support. You need to have paid more than half of the costs for keeping up a home for the year, and that includes rent or mortgage payment, property taxes, utilities, repairs, maintenance, or groceries. So let's start with that head of household. The head of household status, the head of household is designed for single persons with dependents, but in some cases, keep in mind that married persons can also claim head of household filing status, but to qualify for that head of household status, there are strict requirements. They have to file their tax separately from their spouse. They have to pay more than half of the household expenses. They had to have not lived with their spouse for more than 6 months of the year. They had to provide the principal home for a qualifying child or qualifying dependent. They have to claim an exemption for their dependent, and if they meet all the requirements, then they may be able to file for head of household while they're still married. Now, there are situations where we can have 2 people filing for head of household post-divorce, and this is something that you want to make sure you're taking into consideration. When there are 2 or more children with equal placement, the parties may both be able to claim head of household, and this is a drafting tip. You want to make sure that in your decrees that you're awarding one person for tax purposes 184 overnights per year for that child. If it's exactly equal, then technically neither of them have majority placement. So you want to make sure in your decrees you're including a provision regarding that additional overnight so that we know who is going to be able to claim head of household for the child. There were some changes to head of household under the tax reform. In 2017, the standard deduction for filing head of household was $9,350. In 2018, the standard deduction for filing head of household will be $18,000. To be eligible, the again has to have more than 50% of the time. So again, that's why it's so important to make sure that in that drafting we say who's going to have that additional time. But beginning in 2018, a tax preparer must go through a checklist to make sure the parent claiming head of household is actually eligible. Interestingly, they think of everything. The taxpayer may still be able to file head of household even if the qualifying child was kidnapped. So keep in mind. Marital status, just in case. I was making sure you guys were awake. For marital status, the taxpayers are considered married. If they are married and living together, that's obvious. If they're living together in a common law marriage recognized in the state where they reside or where the marriage began. They're married and living apart but are not legally separated under a divorce decree or separate maintenance. They're still married if they're voluntarily separated. And then separated under an interlocutory decree of judgment. So you can see, you can file single or head of household if you're unmarried, but what about when you're these married folks? What can they do? So married people have options. They can file joint or separate, and just because you file jointly one year doesn't mean that you have to file jointly every year. And separate means same deductions, and both itemized and standard. There were some changes, some pretty substantial changes under the tax reform to married filing joint. The mostly unaltered, under married filing joint, it's mostly unaltered under the tax reform except for the standard deduction amounts and the marginal tax rate. So in 2017, that standard deduction for married filing joint was $12,700. In 2018, round of applause, it's $24,000. The marginal tax rate will also decrease beginning in 2018. So in 2017, just to give you an example, people earning $50,000 and filing married filing joint. So if their combined income was $50,000, they'd pay approximately $4,663 in federal tax. In 2018, if they're earning $50,000, that they'll pay $2,738. So it's a savings of $1,924, which is a lot for somebody who's making $50,000 a year. Now, if the family is making $275,000 a year, they'd pay approximately $61,776 in federal taxes, and in 2018, they'd pay approximately $48,819. So that family's going to see a savings of $12,957. So big money. So other changes, for married filing separate, in 2017, the standard deduction for married filing separate was $6,350, and now it's going up to $12,000. So now we're going to get into some more interesting situations. So a client walks into my office, and I like to do examples and then see what you guys' answers are going to be, and then we'll, as a group, say yay or nay on that example. And my friend here, who is normally sitting really close to me, you know you're going to get called on, right? It's been 5 years. Come on, you know this is going to happen. You should have saw my name and said, okay, I'm going to sit in the back of the room this time. So spouse said they would not sign a joint, they would sign a joint return, but now they won't. How many of you have had this situation? You're getting called on. See, you learned, right? You said, okay, I'm just not going to say that this happened to me, and then I won't get called on, and then it's fine. You see, we're learning together. All right, sir. The spouse said they won't sign the return, and now, or they would sign a joint tax return, and now they won't. So what do we do? This is Michael O'Brien. Hi, Michael.
Good.
Are you having a good morning?
So far, so good.
So far, so good. Did you have breakfast?
I didn't.
You didn't? Okay, after this, I will not blink an eye if you leave part of my presentation to go get a little Egg McMuffin and coffee. You've earned it. All right, so they said they would sign the joint return, but now they won't, so what do we do?
That's a good question. I'll certainly try to negotiate amongst the parties and try to get the best deal looking at the options that are available, whether it be married filing separately, or married jointly, and see what happened best there. But after that, I'm not really sure what you could do.
All right, well, I can help you. Indeed, I can help you. So a joint return can only be filed, thank you, Michael. I swear, you can go get a coffee. You can get a coffee. Joint return can only be filed if both parties agree and both parties agree to sign the return. So a court's not going to, or should not, although there have been judges who have said it, right? Like a court has ordered, like, you will sign that joint return. Like, technically you can't do that, but you're the judge today. So they're unwilling, if they're unwilling to sign jointly, unless it's a part of a settlement agreement, the court can't order them to do it. So ultimately, best case scenario, what I often do is we have an agreement, at least on a temporary order basis, that the parties are going to mutually agree upon a tax professional and submit all the tax information to that tax professional, and then instruct the professional to file in the most advantageous way for the parties, with the idea that the parties will split the costs, split the liabilities, and split the refunds. Also knowing that there can be a big difference with the benefits of head of household, but the rates of single filing. When the parties are on schedule to divorce in late November or December, I involve a tax professional to determine if it makes sense to hold off that final divorce date until after the first of the year, as it may be a big impact. So having the accountant determine while they're married whether they should, what's going to be most advantageous. And also you'll find that if you go to the person, if they say, I'm going to file married filing separate, and you say, well, the tax professional says that's going to cost you $7,000, they might change their tune, right? In addition, by having the tax professional identify that this is what the liability is going to be, you can then use that and say to the tribunal, when you're arguing the division of the marital estate, that this was somehow a waste by this person making this family incur this $7,000 debt. But that's also, so that's on the temporary basis, but then as a matter of when you want to actually have the divorce, you want to make sure you're being strategic about it, especially when you're having those November and December divorces. Do you get the divorce in November, December for strategic reasons, or do you wait until January for strategic reasons? Because it may be best to beg the court for a final hearing on December 30th. Next question. Married filing separate returns, who gets the house-related deduction? Does anybody know the answer to this question? Who gets to claim it? Shout it out, because my heels are high and it hurts to walk up and down these stairs. Nobody knows. So the mortgage interest and property taxes, only the owners can claim. So if the home was owned jointly, the spouse that actually pays those expenses can claim if it was paid out of separate funds. But if it was paid from joint funds, then each spouse can claim one half, or if they agree otherwise, they can do. They can basically do whatever they want if they have an agreement. Again, another great reason to have that agreement that the accountant identifies the most advantageous way for them to file. Also, if they're divorcing late in the year, make sure everyone is on the same page so you're not getting a phone call 3 months after you finalize the divorce as to who's going to claim the deductions for the house after the divorce, for the expenses that were paid during the divorce. If you don't have an agreement, all of a sudden your client who says, hey, I paid for all of these expenses related to the house, I should get the deduction, and the other side saying, well, no, I was awarded the house, so I should claim all the deductions myself. Avoid the dispute by making sure you have an agreement. There are house-related deduction changes under the new tax code. Deductibility of mortgage interest is modified for the 2018 through the 2025 window. Interest incurred for home acquisition debt, so when you get that initial mortgage for the primary residence or the second home, is deductible up to a total of $750,000 of purchase money. That's $375,000 for married filing separate. For debt incurred after December 15, 2017. If the debt was incurred on or before, then the limit is still that $1 million. Interest on home equity loans, equity debt is no longer deductible. So married filing joint. Why would you want to file married filing joint? Well, the pros are it has the lowest marginal tax rate and the highest deductions. But the cons are you cannot deduct alimony, and you're both jointly and severally liable for the tax debts, and the division of the tax refund deficiency can be an issue. let's say your parties get an annulment. What do we do there? Well, if you have an annulment, it's as if the marriage never existed. And so they need to file amended returns for married years. And there is that statute of limitations for the 3 years. So you've obtained the decree, the annulment, it holds that the marriage is no longer valid. You have to file the amended returns. And on the amended returns, you'll change your filing status to single, or if you meet the requirements, to head of household. Then the next question is, well, what do we do about these huge tax debts that were incurred during the marriage? I don't think Lindsay was married, but the first couple was definitely married. We get to keep updating these with new couples. It's kind of nice. So what do you do about this huge tax debt? So married taxpayer liabilities, you have to meet all of the following requirements in order to be entitled to innocent spouse relief. 1, you had to have filed a joint return. 2, there has to be an understated tax on the return that is due to erroneous items as defined by the IRS, erroneous items of your spouse. 3, you can show that when you signed the joint return, you did not know and had no reason to know that the understated taxes existed or to the extent that they existed. And there's an actual knowledge component of it. And then 4, taking into account all the facts and circumstances, it would be unfair to hold you liable for the understated tax. To qualify for separation of liability under this type of relief, the understated tax plus the interest and penalties is allocated between the parties, but the understated allocated to you is generally the amount you're responsible for. So to request separation of liability relief, you have to have filed a joint tax return and meet the requirements that you're no longer married to or legally separated from the spouse who you filed the joint return with, and you're not members of the same household as the spouse who you filed the return for any time during the 12 months ending on the date you filed that form. Even if you meet the requirements for separation of liability, it won't be granted if the IRS can prove that you and your spouse transferred assets to another as part of a fraudulent scheme to avoid tax liability or to try to keep liens from property. A fraudulent schemes includes defrauding the IRS or another third party, such as a creditor, a former spouse, or a business partner. And the IRS proves that you, at the time you signed the joint return, you too had actual knowledge of any erroneous items giving rise to the deficiency. For the definition of erroneous items, there is information at the end. We have some hyperlinks for you for the links for these different types of relief. And finally, if you don't qualify for innocent spouse relief or the separation of liability relief, you may still be relieved of responsibility for tax interest and penalties through equitable relief. IRS equitable relief is the most general type of relief under the innocent spouse rules, and this form of innocent spouse relief is only one that allows you to get relief from an underpayment of taxes, and it can also apply to understatement of taxes. So we're including a link to the publications regarding equitable relief in the final slides, as there are requirements that the taxpayer should have to meet. So if there is a tax liability, ask your client, did you know or did you have reason to know that there was this tax liability that existed? And then call a tax attorney. So on the IRS, there are some handy-dandy liability flowcharts that are available that you can use to determine whether there would be relief to liability, but this should be in conjunction with consulting with a tax professional. So the exact links are at the end of the PowerPoint for all these liability flowcharts for you. Okay, now we've resolved income, we've resolved the filing status and what to do about that huge tax bill that your client knew nothing about. Now as your client is preparing to file his or her tax return on his or her own, it's time to determine who claims the kids. So we discussed previously that head of household status, which is that status that goes to the parent with majority of placement. You can separate the dependency exemption from the head of household filing, which starts an all-new fight over the kids again. The first thing we need to do is quantify how much we're talking about. If it's a 2-year-old and we have years of claiming, that's a different issue than we're dealing with a 17-year-old. But it's important to quantify for a child what we're talking about. You do not want to spend $2,000 fighting over $1,000, right? Well, although the dependency exemption still technically exists, it's now worth 0. Previously, the exemption resulted in a baseline deduction of $1,400, or $4,100, sorry. It was $4,100, it's now 0. However, the person who has the dependency exemption can claim the child tax credit. So when designating the exemption, the important piece right now is not the exemption, but what comes with it, which is the child tax credit. The rule could change after 2025, so if the parties to the divorce have younger children, it's still worth thinking about the impact of the dependency exemption and including that terminology in the agreement in case the provision ends in 2025. So to qualify for a dependency exemption, isn't she cute? She's now 4 months old, but she's 2 months old in this picture. Do you see how many roles she has? She has so many roles. Bath time is really fun. To qualify for the dependency exemption and its collateral benefits, the qualifying child must be a taxpayer's child, sibling, step-sibling, or their descendant. But a qualifying relative could be a child or a child's descendant, sibling, parent, or other ancestor, like a step-parent, a niece or nephew, an aunt and uncle, close in-law, or any other non-spouse with the same principal residence, but they have to have gross income below $4,150, and the taxpayer has to provide more than 50% of the qualifying relative support. So if a qualifying child, the child must have the same principal residence for more than half the year. Bless you. The child must be under the age or a student under the age of 24, and to get the child tax credit, the qualifying child must be under the age of 17, and there is an additional provision that was added that the child must be a U.S. citizen or a resident with a taxpayer ID number. The child cannot provide more than half of his or her support. So when you have that qualifying child, if the taxpayer if the dependent is qualifying, there are these 5 different benefits that can be claimed. The dependency exemption, which is, again, now worth 0. The child tax credit and the additional child tax credit, which we'll talk about. The head of household filing status. The credit for child care expenses. And then also the earned income credit. So a closer look at the child tax credit. It generally must be a qualifying child under the age of 17, and they have to be a U.S. citizen or a resident with a taxpayer ID number. The maximum credit for the child tax credit is $2,000. That's up from $1,000. The credit will be phased out starting at $400,000 for joint returns and $200,000 for all other taxpayers. And this credit results in a $2,000 reduction of tax liability per child, and up to $1,400 is refundable in excess of tax liability. The ability to get the $1,400 is referred to as the additional tax credit. So previously, we may have trended to giving the exemption to the lower income parent because the child tax credit couldn't be taken by a person earning more than $75,000 annually. However, since the income thresholds have increased to $200,000 for all taxpayers, many more of our clients will benefit. In a way, having the exemption is worth 0 and the child tax credit worth $2,000 kind of simplifies things. Before 2018, the child was worth different values to the parents based on their earnings. So now the dependency exemption child tax credit is worth $2,000 across the board, unless you run into really low income where there is no tax liability, and the benefit there is the $1,400. So the child tax credit serves as a dollar-for-dollar reduction in tax liability. So even if the tax liability is 0, you can still claim the tax credit and get that $1,400 back in that additional tax credit. Since the child tax credit goes with the exemption, IRS Form 8332 is needed. The child tax credit can only be claimed for a child who is under the age of 17 on or before December 31st of that tax year. So the IRS default rules, if a divorce decree is silent regarding the dependency exemption, it remains with the custodial parent. And the custodial parent is the parent who has the physical placement of the child for the greater portion of the calendar year, and it takes only 1 day. But what if you have that equal placement? In the equal placement time rules, parties can agree otherwise, so you want to make sure that that Form 8332 is you have in the degree that they both agree to sign Form 8332, and it's never actually equal. So if you don't have a provision in your decree that says for purposes of tax purposes, the parties agree that this person has 184 nights, there can be issues if they could say that, and then all of a sudden this person who on paper has placement for majority of the time isn't actually exercising it, so that can become a real issue. So you want to make sure that your clients are exercising their time, because if your client's keeping a record of the days that they're actually having placement, they can have a fun time by both filing the tax returns and seeing what the IRS says about it, which if they do that, one of the returns is going to be rejected and then it'll be reviewed. I do have a publication here for you guys at the end, that Form 8332 that needs to be signed. So dependency exemption for the non-custodial parent. There is a special rule for children of divorced separated parents if the child received over half of his or her support from one or both of the parents, and the child was in the custody of one or both of the parents more than half the year, then that custodial parent, and the custodial parent signs that 8332, the child will be treated as a qualifying child of the non-custodial parent for the dependency exemption, the child tax credit, and the additional child tax credit. The custodial parent, however, keeps head of household and claiming the daycare expense. So is it worth fighting about? Well, there's that child tax credit. We talked about it increased from $1,000 to $2,000. And there's the phase-out thresholds increased from $110,000 for married filing joint to $400,000, and $75,000 for individuals to $200,000. So it's limited by the amount of tax liability. And again, we talked about that additional tax credit up to $1,400. This is for those low-income taxpayers who otherwise wouldn't receive benefits of the non-refundable child tax credit. The dependency exemption, the value of the dependency exemption in 2017 was $4,050, and now it's worth $0. The child tax credit is that $1,000, and then phase out, and then $2,000. So just so you could see what it looks like. So what are some possible solutions in situations where you have options and parties are willing to negotiate it? You could agree that the exemption just follows the IRS rules, and then it's just a matter of, all right, whoever was the majority parent is going to be able to claim the child for purposes of head of household as well as the dependency exemption. You could alternate years with the option to sell or trade to the other spouse. Another option to consider is that it goes to the most advantageous filer, and then you could either divide the savings with other spouse's child support or otherwise just split it equally. You can also make it contingent on compliance with other provisions of the decree, for example, that the person is current on support as of the end of the year. The problem with that type of an agreement is, what if the support was paid in December, but that the system didn't record it into January? Then you run into issues of, were they current, were they not current? So those are just some options. Benefits that are only available to the custodial parent include the Child Independent Care Credit. So it's $3,000 maximum benefit for one child and $6,000 for 2 or more children for care expenses related to any dependent who is disabled or qualifying child under the age of 13. There are also educational tax credits that are available, the American Opportunity Credit, and then the Lifetime Learning Credit that's only available to that parent. I have a little diagram here to show you. So if a person is, if they have one qualifying child, the earned income amount of $10,200, the earned income amount, then the max amount of credit is $3,468, and that phases out. And so you can see the phase out levels on here, but it's a nice diagram to refer to that's going to be in your presentation. It's in, you had an option today of having either the the jump drive or the folder. It's in both of those. But the jump drive, you could just pop it on your computer. It's available to you at all times. Next, let's move on to child support and alimony. So child support is non-taxable to the recipient, non-deductible to the payor. This was probably this is an area that's unchanged. Child support is child support if it's designated as child support. There are reductions tied to a child's pivotal birthdays. There are reductions tied to a pivotal child event. For example, if the child is employed, the child dies, or the child graduates, or a reduction that's clearly associated with a child-related event. Alimony had some changes. Alimony is currently deducted from the payer's income and taxable to the recipient. So significant new law changes. Starting in 2019, the IRS code have been totally stricken from the tax code related to Section 71, which is the deductible support payments. It applies to all divorce or separation instruments executed on or after January 1st, 2019, and to any pre-existing instrument modified on or after January 2019, when the modification expressly provides to apply the new rules. So if it says apply the then existing laws, if your decrees previously said that, it would apply to the new laws. So for divorces finalized before January 2019, where maintenance is awarded but may be modified in the future, if you don't want the new rules to apply to a modification after January 1st, 2019, you should include a specific provision stating that the parties expressly intend for the maintenance to remain taxable to the recipient and deductible for the payor. I think that there was a lot of hype here. People thought, okay, now everybody who was potentially going to get divorced is going to just go get divorced because they want to take advantage of these tax laws. Because there are it's a huge benefit, not just to the payor. It's a benefit to the payor because it's going to reduce his or her tax liability. But it's also a benefit to the recipient, and the recipient would want to take advantage of this because there's more available. They are paying Uncle Sam less, so theoretically, you could get a cut of that. Definition of alimony is payment in cash received by or on behalf of a spouse under a divorce or separation instrument, which does not designate such payment as a payment which is not included in gross income under this section. This is how they write Section 71. And the payee spouse and the payer spouse are not members of the same household at the time such payment is made, and the payment terminates on the death of the payee. So this is independent of the state's definition. This is what the IRS's definition is, and they the parties have to meet all requirements. Their intent is not a factor. They have to meet all the requirements. I always, those situations where the parties divorce and then they start to reconcile and they start to live in the same household together, that becomes an issue. If they become members of the same household, that's going to impact the deductibility of that maintenance, so keep that in mind. Good intentions, but still child support. Remember we talked about child support and you're like, well, why is she bringing up these significant events? It's because you can turn maintenance into child support. Payments terminated on contingency related to a child are child support. So even though you're calling it maintenance, if you have it that the wife is going to pay husband maintenance up until the child graduates high school, you have now created child support. Or if you terminate it on the child's 18th birthday. If it's contingent on the child marrying, dying, employment, school, college, then you're in a situation where you're creating recapture rule issues. So payments associated with a contingency, a presumption exists that payments are clearly associated with a child-related contingency if the payment reduces within 6 months of a child reaching majority age, or there's an alimony step down on 2 or more occasions that occur within 1 year of a child reaching the age between 18 to 24. So this is a time when it's really important to find out from your client, all right, get the child's accurate birthday, find out whether they are on track to graduate at the exact time that you would assume that they would graduate. Like you're assuming, okay, they're going to graduate 18, but maybe they're graduating earlier. This is going to be a child that's probably going to graduate later. You want to get those dates and start mapping it out. So long as the alimony requirements are satisfied, payments for rent, taxes, health insurance, life insurance of the payee spouse under the terms of separation or divorce documents will qualify as alimony, but they have to be written in the divorce instrument, and the payments made to the maintain the joint property or property owned by the payor do not satisfy this requirement. So what we were talking about just a second ago is the alimony recapture rule. So there's a handy-dandy flow chart that we're going to go into. But when the amount paid in the third year, we were talking about the recapture if there's recapture if it is child support, then there's also the alimony recapture rule. When the amount paid in the third year plus $15,000 is less than the amount paid in the second year, and when the payments in the second and the third year are averaged, and this average plus $15,000 is less than the payments in the first year, get it? It's getting confusing, right? Does not include payments made under a temporary order, only under a final document or a payment made on a percentage of income over 3 calendar years. So confused yet? Well, there's a worksheet, and I included it. So your client pays their former spouse, as an example, $50,000 in alimony the first year, $39,000 the second year, and $28,000 in the third year. Is there any recapture? Well, there's a worksheet. Worksheet 1 is the recapture. So whenever you have a situation where you're going to award alimony and there are children, 1, you want to check the dates. When does the child graduate? When is your child getting married? You wouldn't know that. But what is your child's birthday? Figuring out all of that and mapping it out. And if you say 10 years of support, make sure it's not within 6 months of those events. But then you also want to use this worksheet to make sure you don't have a recapture issue if you have step downs. So under this example, you have the $39,000 and then the $50,000, you'll see that the payer would have to claim the $1,500 based on the worksheet. $1,500 would be recaptured. So it's not that the entire support payments would be taxable, whereas if you make it contingent on a qualifying event, all of the payments could be taxable. Under this, it's just recapturing that $1,500, and the recipient would also line item $1,500 to exclude that from his or her taxable income as well. So some alimony tips, dollars. We have 7 here for you. So first, under dollars, clearly outline the amount that is paid within the document. If the order is going to be a percentage of income, define what income is. What about those fringe benefits of employment, and what do we do about those business owners, especially in situations with the tax code changing for business owner and the deductibility of expenses? Are we going off of just what the tax returns say? How are you going to define what that income available for support is? Be clear. On the issue of benefits of employment, if they get a company car, is that going to be included or excluded from that person's income available for support? Next, designation. Indicate that these are taxable support payments to the recipient, and you may want to consider a provision that expresses this intent and a reconciliation process in the event the payments are not deductible for any reason. So in all of my decrees, and I've been putting it in there for a long time, is I've had that this payment is going to be taxable to the recipient and deductible to the payor, and in the event there's a substantial change in the law where these are not taxable and not deductible, then there's going to be a reconciliation, and the question is, who do we make whole? Because it's going to be different. I obviously drafted it with my client being made whole because I drafted it. But the other side, if the other side is drafting it, you'd want to read it, and it would be a topic of negotiation because it's going to be a different number to each of them in order to make them whole so that your client's not stuck, if your client is paying the alimony, isn't going to be stuck with paying this high amount and not getting the deductibility. They would recover the deductibility. I've even included provisions like which expert they're going to use to determine that and to really get into detail. Granted, it makes your decrees a lot longer, but they're really specific, and you don't have the guesswork, and you don't have the litigation costs that would otherwise arise in the event there's an issue. In addition, making sure you're explicitly stating in there, in the event of a modification, don't just say what the current laws are, which is a common provision to say that the child support will be based off of whatever the current laws are at that time. Make sure you're not saying that on the maintenance section, because you want to make sure that it's going to maintain its deductibility, or maybe you're not trying to maintain the deductibility. If you have that intention, make sure it's clear. Then distance. Make sure you stress to your client that should the parties choose to cohabitate in the future, either reconciliation or otherwise, this would impact the deductibility of the payments. They have to keep their distance. Death. The payments terminate upon the death of the payor. It's really deductible. They stop at the death of either party. Dependents, double check the significant events to make sure that the child's not graduating, turning 18 to avoid the presumption of child support issue, and declining. If the award is declining over time, make sure you run the payments through the worksheet 1 to avoid that recapture issue. Next, we're going to talk about property division and tax consequences. So the general rule is that property transfers between spouses incident to a divorce are not taxable events. Retirement accounts are a big one. You need to make sure when you talk to your client initially and say you're going to have to give him or her 50% of your retirement account, that you don't have this overly eager client who's going to just, okay, I liquidated my account, here's half of it, let him take it. Okay, that is not what I intended. I need you to go put that back in there right now. So if it is a qualified account under ERISA, you want to make sure that your client is using a qualified domestic relations order. And the qualified domestic relations order is a really good tool for retirement accounts. I am frequently using qualified domestic relations orders in situations where the parties have debt, or there's just not enough cash in the estate. Let's say they have retirement accounts and they have a home, and I have a dispute where one party wants the house and the other party wants to have the ability to buy a house but doesn't have a down payment. It's called the circular flow of funds. So what I would do, let's say husband and wife wants to keep the house, husband has a retirement account but wants to have a house. What you would do is award, let's say otherwise, husband would keep his retirement account and wife would keep the house. The circular flow would say, use a qualified domestic relations order, award a certain percentage of that retirement account to wife. And then wife, in turn, will complete all of the forms that are necessary to liquidate the benefit that is going to go to her. She will then, when she liquidates, 20% of the amount that she is to be receiving is going to be automatically withheld for tax purposes. But keep in mind, you're going to say then the remainder would go to husband, but that 20% is not going to be her total tax liability unless her income is like real low. So I include provisions that, in addition to the circular flow, that you would have a reconciliation. So in that tax year, wife would prepare her taxes 2 different ways, one with the money that she received and one without the money that she received. And then the difference would be the amount of tax liability associated with those funds. Now, what's smart to do is to buffer that 20% that's withheld and say an additional percentage. And there are lots of there are online tools available, but also you can use that handy-dandy accountant or tax professional that you had to actually calculate for you ahead of time, especially if she's a W-2 employee, exactly what the liability is going to be to her, and then have her pay it directly into the IRS or the state of Missouri to make sure that that is taken care of. And then the reconciliation won't be as much. So for example, if you didn't do that and there's an additional $10,000 liability, but husband already used the money for a down payment of the house, he doesn't have the $10,000, well, then you're like, okay, now we need to do another qualified domestic relations order and award her more of the retirement account, amend the divorce judgment. So to avoid that situation, having a set aside is a good idea. This is a strategic way to try to help families. They're still going to pay income taxes, but they avoid that tax penalty that husband would have if he would take out the early withdrawal. So this is an entire scheme in order to avoid the early withdrawal, and that's by use of the qualified domestic relations orders. But it's an option there for the parties. Yeah?
How much are they saving?
The penalties can be substantial. For example, let's say my client makes $200,000 a year. He takes money out of his retirement account, big hit, right? You know, he might end up with like a 50% hit on his, you know, he wants to take $20,000 out. He's like, great, I have $10,000. Wife, on the other hand, maybe is a stay-at-home mom. And she doesn't, and let's say she's not even receiving alimony. She has nominal income. Her tax bracket is so much lower than his, and he's avoiding the penalty. So you'd really want to take it in situations where there's a huge disparity in earnings. It's a really good good tool in situations where there's a big disparity in earnings. She is paying income taxes. Recognize it for the back, you probably didn't hear it. So he's like, well, she's not avoiding the penalties. She is avoiding the tax penalties by going through the qualified domestic relations order. It's a difference between taxes and penalties. There are penalties that the husband would pay if he removed from his retirement account in addition to income taxes. She's only going to pay the income taxes and none of the penalties. Right? See, you got an Egg McMuffin, coffee, and advice. Oh, it's fruit? I'm terrible. I thought it was an Egg McMuffin. It's really pineapple and melon. Someone needs glasses. Then we have the non-qualified plan. So all this creative work that we talked about is really a tool that's only available to ERISA qualified plans. So when you want to do something creative like this, the first thing that you're going to want to do is get on the horn with the plan administrator. And by calling the plan administrator, you'll want to make sure, are you going to accept a qualified domestic relations order? Are you an ERISA-specific plan? You need to get on the horn and ask that. And while you're on the phone, make sure you confirm whether or not there's like loans out on the account, because that can really throw off some of your great strategic plans. Then you find out, oh, you took a loan for all of this account. Great, this is really unfortunate. So you'll want to confirm with the plan administrator. But let's say it's an IRA. An IRA you cannot do this with. So this fun, creative, circular flow, it's not an option with an IRA. So those non-qualified plans get the same treatment if the rules are followed, but they have to either use a domestic relations order, big difference between a qualified domestic relations order and a domestic relations order. So you can use a domestic relations order, and most plans will accept that. Also, most plans have their own forms that they prefer that you use, and your life will be easier if you use their forms because they will approve it faster. And in that situation, what they want to see happen is they want to see an additional account created, and they will transfer the funds from one account to another, and that's how you avoid the tax consequences. It is important that when you have a client who has an IRA, that you as the attorney review what form they fill out. Because oftentimes the agent that the person is working with who has their IRA may not know, may have never been through a divorce themselves, and they may not really know what they're doing. And so oftentimes I've seen my clients, more times than I can count, I tell them, okay, get the form from your agent for the transfer of this account. And it ends up being a liquidation form. And then the client liquidates as opposed to just doing a transfer incident to divorce. So you want to make sure that you're involved in that process and making sure that it goes smoothly, and so you're not creating a taxable event when you're transferring the interest in this non-qualified plan. But big thing for the client is don't do anything yourself. This is going to be a process. A big thing with qualified domestic relations orders as well is I explain to clients it's going to be a process. This is not going to happen tomorrow. You're not going to have your down payment for your house within 30 days. It's just not happening. The plan has, I believe, up to 8 weeks to just to process, but they have even longer to approve. So the process for a qualified domestic relations order is you draft the qualified domestic relations order, or you retain another professional to draft the qualified domestic relations order. Many plans have their own samples, but I personally, we do not draft qualified domestic relations order unless you are an LLM attorney. And so in that situation, you have the qualified domestic relations order. It's always best to have it pre-approved by the plan, so you will send that to the plan administrator, and they will take their time and send it to their lawyers to review the qualified domestic relations order to make sure that they are going to approve it. I've seen that take a week. I've seen it take months. And it's something where you have to hound the administrator. But it's something that you can't provide any guarantees for your client what's actually going to happen. Then once the plan administrator approves it, that's when you would want to have it filed by the court. The reason you'd want to pre-approve that is because if the language is not going to be approved, you get an order from the court, then you have to amend that order and get it recertified. It's an additional process. So best practice is to get it pre-approved, then get it signed by the judge, then send it out to the plan administrator, and I believe they have 8 weeks to process it once they have a qualified order that's certified by the court. And keep in mind that it has to be certified. There has to be that extra certification stamp for the plan administrators to accept and process a qualified domestic relations order. Make sense? And then the other forms that I haven't seen, most of the forms that are for the IRA to IRA transfers typically don't even require the judge to sign, but you can get a domestic relations order if it's a unique plan and they're being disruptive on getting the forms over to you. Then on the topic of the marital residence, we have to look at what the gains and losses are. So the gains and losses are the cost basis minus the sales price. And the capital gain exclusion rule is for $250,000 for a single filer. And there are criteria outlined in Publication 523, Selling Your Home, which is included here for you. The exceptions to the general non-tax rule is non-qualified stock options and deferred compensations are considered income and not property, so their tax transfer is not tax-free. The reason being is because taxes will be withheld at the time of payment, and that's under the IRS rules. So when I'm having a situation of stock options are really unique when you're going through a divorce. There's questions of, are we looking at the vested interest or the unvested interest? And are we liquidating, are we not liquidating these stock options? And also making sure, is it a option to buy or do they actually own stock? These are all questions that you want to make sure you're getting on the horn with the plan administrator or the HR representative of your client's employer to get a good understanding. It's very unique what we would have to do in these types of situations because oftentimes they are not transferable. And so because they're not transferable, if there's liquidation, then there's going to be that taxable event right away. What we'll do is we will have it won't be a transfer with the company, but instead we will have that person have a fiduciary interest and hold the spouse's portion, the spouse's options for him or her. And in that situation, you want to make sure you're very clear, one, how many options are awarded to the non-employed spouse, and also be very clear which options. Is it 20 options that were awarded last year or 20 options that were awarded 15 years ago? And so oftentimes I'll include a chart exactly who is being awarded which stock options so that it's very clear upon liquidation. And then you have provisions that are included as to, okay, now is the time when you can liquidate and what is the process and how those tax consequences are impacted. Remember, for that qualified domestic relations order, when we did that circular flow of financing, we did that prepare the tax return 2 ways to make sure we captured the actual tax liability to that person. You would maybe want to have similar language, and in my stock option cases, I have similar language where there's going to be a reconciliation to make sure that the person who is the employee or the person who is receiving the funds isn't going to pay more or less than they should have had to pay to make sure that everyone is made whole. So taxes are complicated. They really are. I went through the entire thing, and my goal was to say I'm not gonna. What is it? There's the only thing that's true is death and taxes. I think it's something like that. I wasn't gonna say it because I couldn't remember it, because clearly to me pineapple and mango are Egg McMuffins today. But they're complicated, so know when you want to employ an expert. So the experts that I typically have in my back pocket, I would have an accountant, a business valuation expert who's going to help you read those taxes. There are also certified divorce financial certified CDFAs. CDFAs also can assist you in this process as well. And finally, a tax attorney, especially in situations where there is that innocent spouse or your client's trying to get out of paying a certain tax liability. Typically, in those types of situations, it's a sizable amount of tax liability that we're dealing with, so we want to make sure that we are not taking that on ourselves unless we are tax law professionals and we're passing that work on to someone else. And to that, thank you, everyone. If you look at the links on your jump drive, when you download the presentation, you'll see these links. So we have that link for the innocent spouse relief, the request for innocent spouse relief, the liability flow chart for innocent spouse relief, bless you, IRS Form 8332, which again has to be signed if the the parent who has less percentage of time is actually going to claim that dependency exemption child tax credit. They need to secure that 8332. Worksheet 1 for recapture of alimony, and then selling your home. There's a worksheet there available for you as well. All right, and with that, thank you all very much, and Scott will come up here to introduce our next presenters.